Imagine waking up tomorrow morning. You walk to your local ATM, insert your card, and wait. But instead of cash, the screen flashes a message that freezes your blood. System error, balance unavailable. You check your phone. Your banking app won't load. You turn on the news, and you see lines of people stretching around the block outside major banks. The doors are locked. The lights are off. This sounds like a scene from a movie, doesn't it? But for millions of people in history, from the 1920s Germany to modern-day Lebanon, this wasn't a movie. It was reality. We live our lives believing that the money in our bank accounts is safe, that it is an asset we own. But today, we are going to challenge that belief. We are going to explore a system that most people use every day, but almost no one understands. Welcome to the Empire of Money. In this episode, we peel back the layers of the global economy to reveal the invisible mechanism that powers our world: debt. To understand where we are going, we first have to understand where we came from. For most of human history, money was tangible. It was gold. It was silver. It was copper. If you worked for a day, you were paid in something that had physical value. You could hold it. You could melt it down. It was yours. This system, known as the gold standard, acted as a natural brake on government spending. A king couldn't wage an endless war if his gold reserves ran dry. A government couldn't build massive projects without taxing its citizens first. Reality was a check on power. But in the 20th century, something changed. Governments realized that gold was too restrictive. In times of crisis, like the Great Depression or World War II, they needed to spend money they didn't have. They needed a system that was flexible. So, step by step, the link between money and gold was weakened until 1971, when it was cut completely. The United States, facing mounting debts from the Vietnam War and social programs, made a historic decision. President Richard Nixon announced that the U.S. dollar would no longer be convertible into gold. In that moment, the dollar transformed. It became fiat currency, a currency backed not by physical assets, but by government decree, by trust. Now you might ask, if money isn't backed by gold, what is it backed by? This is where the story gets interesting. In our modern financial system, money is largely created through the act of borrowing. When you go to a bank to take out a mortgage, the bank doesn't necessarily hand you money from someone else's savings. Instead, new credit is created. You sign a contract promising to pay back the loan with interest. In that moment, digits are typed into a computer, and money appears in your account. It's a brilliant system. It allows economies to grow faster than ever before. It allows us to buy homes, build businesses, and innovate. But it comes with a hidden cost. Because money is created as debt, the economy must constantly grow to pay off that debt. It's like a bicycle. If it stops moving forward, it falls over. This need for perpetual growth drives everything around us. It's why prices tend to rise over time. We call it inflation. Think about the price of a cup of coffee or a house 50 years ago compared to today. Has the coffee become 10 times better, or has the money in your pocket become weaker? Inflation is often described as a natural economic phenomenon, but many economists view it as a hidden transfer of wealth. As more money enters the system, the value of existing money dilutes. It rewards those who borrow and invest, but it often punishes those who simply save cash under the mattress. But there is a bigger picture here. We are currently living in an era of unprecedented global debt. Governments, corporations, and individuals around the world owe trillions of dollars. History teaches us that debt cycles are a natural part of the economic rhythm. They rise, they peak, and eventually they reset. We saw this in the panic of 1907. We saw it in the crash of 1929. And we saw a glimpse of it in 2008. In 2008, the world learned how interconnected our financial system really is. A crisis in the U.S. housing market rippled across the globe, toppling banks and wiping out retirement funds. The response from central banks was swift and massive. They lowered interest rates and injected liquidity into the markets to keep the gears turning. It worked. The system stabilized, but the underlying debt didn't disappear. It grew. So where does this leave us today? We are in uncharted territory. The global financial system is more complex and massive than at any point in history. Some argue that technology and innovation will allow us to manage this debt forever. Others look at historical patterns and worry that a correction is inevitable. This is not a message of fear. It is a message of awareness. The debt illusion is the belief that the current stability is permanent. But history shows us that the only constant in economics is change. Empires rise and fall, currencies evolve, and wealth moves. The people who survive and thrive during economic shifts are not the ones who panic. They are the ones who understand the rules of the game. They are the ones who diversify. They own real assets. They educate themselves. The empire of money is not built on paper. It is built on knowledge. The global economy is a fascinating, complex machine. And while we can't predict the future with certainty, we can certainly learn from the past. So, as you go about your day, take a moment to think about the money in your pocket. What does it really represent? And are you prepared for whatever the next chapter of history brings? Think about it.